Well, good morning. Thank you all for joining us. We have several that are still connecting to audio, but we're going to go ahead and get started. I will start by introducing myself. My name is Teresa Campbell. I'm with PIA Mid-America. And for those that are new, you have joined this month's Financial Executives Council program on tools and strategy for benchmarking business performance. This is a new program for PIA Mid-America, and we're offering it every other month in partnership with Printing Industry Midwest. It's really focused around financial reporting and compliance, data management and security, and financial policies and planning. The goal is to engage with one another and ask questions and learn and collaborate and share. Before we get started, I want to note that all of our attendees are in mute mode so that we can get a quality recording that will be shared with all of our members, as well as a PDF of the slides following the program. Questions during the presentation portion can be typed into the chat field at the bottom of your screen, and the team will moderate your questions to be answered at the most convenient time. Now, when Stuart Margolis is done presenting, we ask you all to unmute yourself so we can have a rich conversation where you can engage by asking questions and discussing the topics at hand. If you're calling in from a phone line, you can unmute by using *6. And when we get to that portion, I'll remind you to do that. Without further delay, I'd like to turn it over to Steve Bonoff with Printing Industry Midwest.
Thank you, Teresa. It's really exciting to join with PIA Mid-America and your members because we are one family in the print industries and we have a shared set of needs. And so it's great to expand the conversation across more states than we are. So this is a long-running program for Printing Industry Midwest, the Financial Executives Council. We have long been supported by our partners at LB Carlson. And as today indicates, we also include on a regular basis subject matter experts on topics of the moment. And we welcome Stuart Margolis here today. But the reason why this meeting came up is that we recently did a survey of the financial needs of our CFOs and our finance directors. And performance benchmarking was at the top of the list. It was at the top of the list about a year ago and remains so today. So while we want to tackle that issue here today and really to define the some best practices for you in this area, at the same time, we're going to be listening for how we can further develop and bring back to the industry a benchmarking and performance ratio program that was once operated under the banner of Printing Industries of America, led by Stuart Margolis, but for a variety of reasons was paused, and now we're looking to bring it back in a way that meets today's needs. And so we're going to be thinking about that today. We're going to be talking about it throughout, and we just want you to know at some point in time we'll be asking you your interest in participating in such a program. So we're looking forward to have a robust discussion today. And again, I want to welcome Stuart Margolis here. But first, I want to welcome our committee chair, Mel Enger, to kind of introduce he and his team and make any opening remarks.
Yeah, thanks, Steve. Appreciate that. And I too wanted to say welcome, and I look forward to expanding our group with PIA Mid-America for our Financial Executive Council. Steve already mentioned what we try to do on this council, meeting every other month on topics that are important to people. It was primarily set up for financial executives, controllers, CFOs, and so forth. But I just wanted to mention that oftentimes I think the topics we choose are also very pertinent to other management personnel within companies. So as you see future topics being advertised, and if you think it's appropriate for other personnel within your organizations to join us, we would welcome that. As Steve mentioned, he introduced me as the chair. I'm actually co-chair with Ken Ryan of Daily Printing. And also we're adding a chairperson from PIA Mid-America, that's Stephanie Lipinski, I hope I said that right, from Capital Printing. I think Stephanie might have some things to add later on in the program, so we look forward to that. A little bit about future programs. Steve mentioned we did a poll, so we've got a list of some topics that we're considering. One of them I'll just mention was called Planning for Profits on What You Have. That was in the top 5 in our survey. I'm mentioning this because I'm actually presenting this topic June 10th through another association here in Minnesota. And I think, Steve, I'm correct in saying we're going to invite the PIM and PIA Mid-America folks to join in that if you'd like to. So something will be coming out on that. One other thing about topics, if anybody, we're always looking for new ideas and new things people would like to hear about. So if during this presentation, anybody has something they would like to hear about or a good idea, please chat it in and we'll add it to our list for future topics. Yeah, now I just would like to present our co-presenters here. I guess I can say that. Rick Riesgraff is going to help facilitate some of the discussion today. Rick is one of my partners at LB Carlson. Rick's been with our firm for close to 40 years, and his focus has been printing and graphic arts his entire career, and that's what our firm is too. We've been in the print industry for well over 40 years, and we are a CPA firm, so we obviously provide the traditional services there, but also management consulting. And we do have another entity in our firm called LB Transitions, which handles a lot of mergers and acquisitions within the print industry. So with that, I was going to hand it over to Rick, and he's going to introduce Stuart. Rick, you're muted.
You'd think after a year of this, I'd be used to that, but I'm not. Sorry about that. Thanks, Mel. Yeah, it's a real pleasure today to help present on this topic. It's one that our firm and myself in particular have been really passionate about, and I know our clients, our affiliate members that are really good at performance metrics and benchmarking, really are helping themselves become more profitable, become more successful by doing that. We've seen that evidence over the years. We're a big advocate of using these tools, and I'm really happy today to introduce I'll say a very friendly competitor of ours, Stuart Margolis from Margolis Partners. Stuart has been in the industry as long or longer than we have, and has served in many different capacities in that time. But one of the things that Stuart and his firm have done is led and championed the dynamic ratio studies that the Preeminent Industries of America had produced, I think, for potentially 50 plus years. Stuart will let us know about that. And their firm was involved with that, Stuart's father before him. And so I'm just grateful to have him join us. He's also an advocate in the graphic arts industry, helped many companies become more successful. And so, Stuart, with that, I'd like you to take it away and talk a little bit about benchmarking and some of the things that our members can do to help themselves become more successful by using these tools.
Oh, thank you, Rick. I appreciate it very much. And thank you, Mel, too, and the associations for having me here. We've spoken actually quite a bit over the last month or two because Mel and Rick have wanted to restart the ratio study program, and some of their members, some of their clients have mentioned it, and I think maybe that got the impetus started. And I think we're going to get this done this year. Hopefully, sometime by September, you'll get questionnaires and a survey to fill out so that we can get back to doing this again. For those of you who aren't aware, we stopped doing the ratio studies in 2017, which was really embarrassing because it was, to say it out loud, it's 2016 data. So we are now several years behind, and it's time to get started doing that again. Just to give you an idea, my father had started this when he was a teacher at Drexel University here in Philadelphia, and he was working with the National Association. They were having trouble getting the ratio studies out on time, and I always jokingly say that they did a search for a anal compulsive accountant, and they found my father, and he took this study and turned it into a spectacular publication for PIA. But what happened is it started to trail off, and the participation diminished quite a bit. And I think we have worked on and hope to continue to work on being able to increase participation from past numbers so that we can get a good study going and also be able to afford to do it as well. Just to let you know, when I was 8 years old, we would sit in the dining room table. My father would bring home these paper copies of the surveys, the ratio study surveys that he brought in, and he would give us a little adding machine, and we would literally add them back up again to check the veracity of the study. And of course, he gave us the calculator so that we would stay out of his hair. And sure enough, when I got to high school, I also went in and started helping him with that as well. And sooner or later, sometime during my career, working with my father's firm, I took it over and been doing it ever since. So that started in 1961 or 62, somewhere in there. He's never sure exactly when he got started. And we did it all the way through 2017. Because of the ratio studies itself, our firm also built up a clientele of printing companies. There was a 5 to 7 year period where that's the only, I only worked on printing companies. It really gives you a unique perspective as to how multiple companies are managing their profitability. Between that and actually, going out and actually seeing the firms, and then also putting together the ratio studies, where literally you have to look at every survey that comes in to make sure it makes sense. So it gets you an in-depth knowledge of the industry and understanding the quirks behind it. That said, I think I'm hoping that most of the people understand the ratio studies, from the past. I know Marty, I wanted to say hi to Marty. Good to see you again. But there's, I know that they use it, and but just to remind you, the studies have a financial statement calculation where everything turns into a percentage, essentially, at least as a percent for the statement of operation. It turns into a percent of sales. We also do it a different way, which is we'll turn let's say factory costs as a percentage of value added as well. So there's a whole report on operations based on that. We have a balance sheet that has percentages, so you can get what accounts receivable is as a percentage of total assets. And more importantly, you can get equity as a percentage of total assets. And we do a whole series of profitability ratios that measure the profits, sales factors, gross profits analysis, value-added analysis, financial leveraging, liquidity, leverage ratios, investment per employee, employee percentages by classifications. In other words, where are they in the shop? What's the average for a printing company? And payroll costs per employee. All of that is broken down by sales size, which is an important component to the ratio study, because there's a significant difference between a small printing company, let's say 3 million, versus a large one at 30 million. So on my financial statements for our clients, we compare every single financial statement to the ratio studies. The problem we have now is that we haven't had the ratio studies in several years. I don't know about everybody here on the call, but what I've done is I've replaced the percentages that I used to get for the ratio studies with the percentage that I would budget out. So I would love to tell you that 100% of my clients have a budget, but they don't. But I will come up with a percentage budget so that I can use it as comparison. If that makes any sense to you, I hope you can utilize it. But I strongly believe in having a budget. It just doesn't make, my father used to say, it's harder to be profitable if you don't have a plan, or the other way to say it, if you have a plan, you're more likely to be profitable. He also believed that that manufacturing and sales need the direction of the finance department. So if we don't give them a budget or a clear concept of what we expect from the manufacturing and sales, then they just aren't going to be able, not going to achieve what you need them to achieve in order to be financially profitable. That makes sense? I would definitely rethink it if you haven't done a budget. I had a client last year that started off with a really nice budget for the year, and then of course by March that all fell apart, and he told me he's never going to do a budget again. And I said to him, no, you have to do a budget, even if sales dropped after that first quarter. I said to him, you probably should redo the budget if your expectations are that sales are going to significantly change. Of course, that was logical at the time to think that. And so I convinced him to redo a budget based on the new parameters. Of course, it was much harder to project a profit because a lot of our costs are overhead costs. And I'm sure you guys have struggled with that concept over the last year. And some of you may still be struggling with it as well. But that doesn't mean you can't have a budget that shows a loss during times like this, but generally speaking, you'd want to show a budget that's highly profitable. And that leads me to the second thing. In the ratio studies, we calculated two categories. We calculated a category for all firms, meaning all people who participated, and we also calculated a number, a group, what we call the top quartile, top 25% of the firms who are more profitable, or I'll call it highly profitable, and I called them profit leaders, excuse me. And they, this group consistently year after year profits would range, let's say, from between 8 and let's say as much as 11% on sales, versus the all firms category, which would go between 1 and 3%. So it's quite significant of a difference. And I would have CFOs who would prepare budgets that would reflect, let's say, a 5% budget, because the previous year was a 3%, was a 1% result. When I'm talking about the 1%, I mean 1% profit on sales. And you know, it was my job to convince them that they could move into the category of profit leaders and not limit themselves to the 5%. Which gets me to the, you know, this, again, back to this concept of right now we don't have the ratio studies to make a valid comparison to, but I guarantee you that the profit leaders, except for maybe this past year, were at that 8 to 10%. And so preparing a budget to get to that number is still should be your challenge. Does that make sense? I hope it does. Let me just also explain another thing that we noticed over the years. So we calculated the group, the all firms group, you know, and then we calculated the people, am I doing it the right way, on the top side, the top quartile, and we calculated their numbers. And so Dr. Ron Davis at PIA, who retired in the last couple of years, last year or two, asked me to do the remaining 3 quarters. Now let's take out the top quartile, but calculate the average for the remaining 3 quarters. And he asked me how, you know, what does it look like? And it was surprising. The average profitability was break even to 1% year after year. I mean, in the years that we had recessions, it would actually go into the negative numbers. So it shows you that you know that there's on average 3 quarters of the firms are just getting past break even, which is shows you how competitive this industry is, I guess is the best way to put it. But not to knock any one firm or anything or a group of firms. It is a very competitive industry, and it forces the competition is what causes the profitability to be as low as it is. I'm sure you all know that by now, especially the groups or the printers here that are in the commercial industry, commercial printing. For those of you who have specialties, obviously the profit margins are not obviously, but hopefully the profit margins are higher. So we call that group the have. We sort of jokingly say there's the haves, which mean the profit leaders, and then the have-nots that are not, the other 3 quarters. One of the things that I've learned over the years by looking at the ratio studies is I've taken the all firms category and listed them, and then I took the profit leaders and I put in a column that just said differences. Is there any way that I could get, I think it's slide 7 up, sent out to you? Yeah, there it is. So if you look at those numbers, you'll see that the material costs are virtually the difference, or the variance between all firms and profit leaders is 0.04%. So we're obviously not making, the profit leaders aren't making money from the material costs, even though it's logical that the material costs are probably lower, should be, but it just doesn't seem that way. And then if you look, you'll see factory payroll has a significantly wide variance of 2.86% as a percentage of sales. And if you work your way down, you'll see there's a contribution between factory expenses, administrative, and selling expenses of a little over 1% for each of them. You have to remember, in the administrative area and in the sales area, there's payroll costs in those areas. What we have found is that it seems that payroll costs is probably in total, but specifically in the factory area, is one of the leading contributors to being profitable or not being profitable, not being as profitable. And we turned it into sort of a slogan, which is that profit leaders control what they can control. Meaning that as much as you'd like to control your sales, a lot of that is out of your reach. It's out of your control. At least specifically, month-to-month sales numbers are out of your control. And if you look at factory expenses, you'll see that a lot of those costs are fixed. They certainly are in your control, but on a monthly basis, the rent is not going to be in your control because you signed the lease 2 years ago. And you go down and you'll see these fixed costs are certainly in your control, but they're not in your control daily. You've already bought a piece of equipment, so you're going to have depreciation. That's what we call spent costs. It's going to happen no matter whether you like it or not. But payroll costs is one of those costs that you can control daily. It just is. It's hard to believe that you can do it, but you all have done it before, and it shows relatively easily in this particular slide that I just put up. And a lot of the focus on the ratios that I like to look at are helpful for analyzing payroll costs. So that said, I'm gonna just break for a second and talk about talk about return on investment and change for just a half a second here. So I'm gonna, the objective of running a company is to sort of not to make money. The objective is to make money as a relation to your investment in the company. So I'd like to introduce the return on investment calculation. If you could move to that next slide after that. This particular slide shows you how to calculate it, which is essentially taking income and dividing it by assets, which is in the middle of the page there. But there's really two components. It's income divided by sales multiplied by sales divided by assets. I like the concept that I have two things I can control to increase my return on investment. I can control what my income is, so that income as a percentage of sales goes up as high as possible, and I can control how much in assets I purchase and manufacture with those assets, so that I can get a higher return on investment. So normally a CFO spends most of their time working on that left side via reporting income and also calculating it properly, and then of course planning for it as well, I hope. But the other ratio is sometimes not looked at as often. So I suggest that you calculate that ratio on the right and see if you can monitor it on a regular basis and introduce it to management so that the concept is there that every time we buy a piece of equipment, we're going to reduce our return on investment. So if we're going to buy a piece of equipment, we better plan on generating sales increases quickly, or if the equipment is purchased to reduce costs, that it increases the other ratio on the left side there, income divided by sales. So again, every time I go through a major asset purchase, we go through this concept in detail and make sure that it makes sense to purchase any major assets. And I strongly suggest that in order to get management to buy into these type of analysis, you need to make sure that they're aware of the asset sales number. Can you flip to that next slide? Is there another slide after that? Yes, here it is. So because you probably don't review this that often, I wanted to just show you the last time that we did the ratio studies in 2017. You would see what the sales per dollar of, I like to use the second one down, sales per dollar of net assets, which is around 2.4 to 1. So you look on your balance sheet and multiply your net assets by 2.41 and see if that's close to your sales number. I think you'll find it certainly can consume a half an hour to an hour discussion about, why would your firm be different than others if you're lower, and then if you're higher, why is that happening? What's going on? But it's just an intellectual discussion in the beginning, but soon it becomes part of the routine that we can focus on. So I really like that concept of splitting the two numbers and talking about return on investment at least once or twice a year with management. So that's one of my favorite, not favorite, because I get a lot of pushback on return on investment because management says, well, we're just trying to be profitable, but it's really good to get them to talk about that second factor. The other thing that our firm has focused on over the years, and something actually that got introduced to the ratio studies, is taking a look at value added. So the phrase value added could have multiple meanings, I guess, in the industries, and of course spread across multiple industries. It can mean different things. But in the ratio studies that PIA did, we introduced it as just a calculation of sales minus material costs. And basically the word value added could be replaced with inside sales. This is what you manufactured. This is what your firm added to the material costs and sold to your customer. That component of value added is really two components: what the cost was to manufacture that component, that product, I should say, and then and hopefully the profit that also went along with it. But the way it's calculated is sales minus material costs. And every financial statement that we produce for our clients, we try to get them to structure their internal financial statements this way as well, is we start with sales, we subtract the material costs, and we get to the value added. The ratio studies then does a calculation that starts with value added being the common denominator, and all of the expenses below material costs are shown as a percent of value added. The banks don't quite understand it all the time. The management doesn't always understand it, but if you start doing it on a regular basis, they can get used to it. It doesn't mean that you don't calculate material costs as a percentage of sales, but what we do is we start with sales, calculate the material costs and the percent of material costs, and then we start all over again with value added equaling 100%. Then we calculate factory labor as a percent of value added instead of factory labor as a percentage of sales. The overall reasoning behind that is that there's a higher correlation of certain direct expenses, specifically payroll, to value added. So it doesn't get sort of, I'll call muffled by doing it as a percentage of sales. When you do, let's say, factory labor as a percentage of value added, it's a more direct relationship. And the ratio studies, if you did an analysis of that, and you did a standard deviation and the whole type of calculation, you'll find there was a better correlation between value added and the expenses below than it would be to those expenses to sales. Does that make sense? I hope it does. The ratio studies have a statement on it. I think it's on page 12. Yeah, there it is. And this is what it looks like. And there's detail behind factory payroll, factory expenses, administrative expenses, selling expenses as well on the next in the next pages of the ratio studies. And again, to say it out loud, I want you to be aware that we are going to try and do the same thing. It may look different and may have some changes in the counts, but we will be producing hopefully this report this coming. Which I'm very excited about it. You know, I'm a CPA, so I don't get excited about much, but I'm very excited about getting this ratio study done. So I'm glad to say we're finally getting back on track. Could you go to that next slide? Because I just, I'd like to hammer this home a little bit. So, this looks exactly like the last one, but, I just replaced the top lines with value added. You can do the same calculation as income as a percentage of value added and sales, and value added divided by assets to get a better ratio. And again, I was telling you to concern yourself with how much in assets do I need to generate, let's say, 1 million in sales. It may be even a better question to ask yourself, how much in assets do I need to make $1 million in value add? Because again, it just makes sense to me that there's probably a better correlation between assets and value added than assets to sales. I hope that makes sense to you. Now, the rest of this slide doesn't really conform. It doesn't. It says income and sales, but it's meant to be replaced by value added. I think I missed putting in that together, but I just wanted you to see the top part, and I hope you appreciate it. So take it to the next level with your management team and see if you can get them to focus on that as well. But do it in baby steps. You may have to just do this, the right side, starting with sales, and then eventually move it over to assets, to value added. And Rick and anybody else out there, you have to watch the time for me, because I could probably do this all day. And I'm not sure exactly how, whether my voice is loud enough or not.
Well, you're doing good, Stuart. We can hear you loud and clear, and
right.
Time is doing great. So,
the next thing I'd like you to just look at is, it's a total labor cost as a percentage of value added. I think that's our slide 15. We got it. Maybe you should back up to the one before 14. There. Because I probably should say it. I very rarely do I look at costs as a percentage of sales, but I know that most most companies do it. So you can see here that the all firms group is almost at 40% of their cost is labor, and it's higher than the material costs. You know, it's a cross section of the industry. That's the case. Now, of course, if you're a web shop and your sales are above 30 million, you're not going to have that same relationship. But on an average printing company, it's clear that the labor costs are more than material costs. If you look at the profit leaders, the total labor cost has diminished a little bit, down to, let's say, 37%. So 40 versus 37, it's a 3% change. What's interesting is that if you look down further, you add up the materials and add up the profits, you get a total of around 76, 77%, 78%. And the other expenses for both groups is pretty close to each other. We've got a 1.25, let's say, percent difference. It's even less than that. I'm sorry, a little less than that. So again, you know, go back to what I said earlier, you should control what you can control. And if you look at that, it's clear that, and if you recognize the fact that the material cost is something that you should control, but it probably has the least, it's probably something that you control with the least amount of effort. Don't tell your plant manager I said that, but most likely you can control it. Most of your concentration probably has to be on the labor cost in order to be a profit leader.
Stuart,
yeah.
Can I interrupt on that question?
Sure.
You know, I agree totally on the largest controllable cost that you can have in your printing plants is usually the labor component. Have you seen an increased focus on that in this COVID environment with printing companies? Has that become even more important?
Well, what I saw initially was the deer frozen in the headlights. So you went through that, right? And then, you know, it was good to get that PPP loan. But the truth is that there was a hesitation of letting, you know, controlling that labor cost because we were getting remember that initially it came out with an 8-week window, you had to spend that cost. And so there was a little hesitation there to reduce the labor cost. And of course, we were probably still rationalizing that this COVID thing was going to be over by the summer or something like that. So a lot of the printing companies just didn't reduce their labor costs like they should have, with the reduced sales numbers and a reduced value added number. But by the third quarter, I certainly started to see, you know, firms who realized that they were running out of PPP money and they needed to make changes. But maybe you could just tell me, I mean, what's the range of loss of sales that you saw in your group of printing companies? You're on mute, by the way.
Yeah, we saw the same thing. It was first of all, there was a confusion of COVID and then the hesitancy to manage this, but we have really seen a razor-like focus on this in the last half of the year, 2020, and certainly this far in 21. So these labor metrics that you're mentioning, I just think are ever more important, and comparing yourself to the targets and the goals you have, I think are really critical now to keep everything going the way we want it headed. I see Ken Ryan had a question here related to this too. He said, use the ratios to analyze our financials. How do we evaluate the past year with the mess that COVID caused? Our numbers, everybody's numbers, I think for 2020, maybe even 21 are so off. And I think we're gonna have to focus on that in the future ratio study. have you given any thought to that at all, Stuart?
No, actually, I actually trying not to think about it because I don't want to pause the ratio studies, production this year for another year because we're going to get bad results for sure. At least I think that's what we're talking about. But it'll be a good year for the first year to start up. We'll have a really low benchmark, and that means that in future years we'll always do better than that first year. That makes any sense. I'd like,
Stuart, there was another question that came in about with labor costs, should you include payroll taxes and benefits? And I guess the way I usually do that is I just like to focus on the compensation dollars first and measure that. And but I do like to look at benefits more as a percentage of labor to see how that matches up, because there's quite a few companies and firms out there that have excessive benefit costs too, as opposed to others. So I usually like to just separate the compensation from the other parts of it, but you can do it both ways. Yeah. You agree with that?
Yeah, I do. I think what's good about doing it separately is that you suddenly have to focus on the specifically the benefits portion of it so that you don't forget it, and that makes everybody think about it. Versus if you just do total payroll, and then they maybe they don't want to look at the benefits as a percentage of their labor cost because they're trying to avoid causing any issues. The more controversial there is, that's the better.
If you don't mind, could I add a couple comments here?
Yeah, please do.
Yeah, I think Rick and I both agree with labor costs being the number one area to look at. I've always said that if companies control and manage every other cost in their company well, but they don't manage labor costs well, I think you'd have a tough time doing well. I think labor has to be focused on all the time. And the other comment I just wanted to make is I've used these ratio studies my whole career, and I think they're great. I think they're an excellent tool. And when you do these analysis and you see these differences in labor costs and you think, oh boy, I'm off 4% from everybody else, I've got a problem. What we found is that you can quantify that you have a problem, but you don't necessarily know where that problem is. And it's generally not just one thing, right, Stuart? I mean, it's not like, oh, I'm high in labor costs, I better cut some people out or terminate some people. It's not that simple. It can be in a variety of areas. It can be headcount. It can be how much you're paying them. It can be how you're pricing your work. Maybe you're not pricing your work well enough and it's causing labor costs to be high. So just don't jump to the conclusion that you have too many people. It may be something else.
Absolutely. Yeah, what I do is something I try and look at all of these variances and percentages. So if I find that, let's say, this particular printing company's material costs are higher as a percentage of sales than the average printing company, or what the expectation would be for that particular company, and also the labor cost is higher as well, it probably means that their pricing is off. I try and use other factors to show the fact that their labor costs, it's not just their labor costs, it's their selling price. Try and look for other things like that, and to help complement, what direction we should head in. If you can feel comfortable that the pricing is correct, and I don't know any printing company that says, "Oh yeah, we're real comfortable with our selling prices." But you'll never hear a printing company say that. But if they've been at this long enough, they know that there is no magic formula for it. But if their pricing is within a ballpark, the best way I find to do it is to use the total of labor costs Can you go to that next slide, which is, I'm sorry, a couple of numbers. Again, I like to look at it this way versus the other way. And Mel, you had mentioned, you know, when you look at the total payroll costs, you almost know whether they're going to be profitable or not. I use this 60% number as the fail-safe number. If you're a commercial print shop in the sheephead area, and you go over 60%, you're not going to be profitable. You know, I could say it out loud with a little bit of confidence, with a lot of confidence. And I don't care where your employees are classified. You know, it's there somewhere in there. You got a problem. So assuming again that the sales price is not overstated, understated, and I just say to them, we need to be at 54%, and this is the hardest part, is you get the whole management team together. I don't know if you ever read Good to Great, but there's a great discussion about these leaders that come together to discuss where their company's heading. I always picture a printing company where you get all of the managers together who, by the way, are protecting their employees, and say to them, we can't run at 60% labor costs. We have to get down to 55. And, you know, the plant manager says, well, I think that the accounting department should take a reduction in pay. And then it goes around the table. But sooner or later, if you get the whole group working together on it, maybe you can find a way to get that down. Again, I agree with the hardest part is not knowing what's really why your company's at 60 when it should be at 55. You know, you look at all the strong personalities and you put them all together in a room, you could end up picking the wrong one, the wrong cost to cut, if that's the direction we're going to take now, assuming that the pricing's right. But in the end, that's what needs to work. You have to figure it out sooner or later. You can't be profitable. And then, of course, if you had a big drop in the sales numbers, oh yeah, I wanted to mention that, you know, I have my clients have had a reduction between 10 and up to 40% reduction in their sales numbers. I have some high-end producers that, let's say, produce, you know, let's say the high school and college materials that are, every one of them seems to be better than the next one. There seems to be a big freeze in those types of sales. You know, it's the higher end commercial work seem to have been hit the most in my mind. I have label manufacturers that have over 5% or 7% reduction. You know, that first couple months, but thinking, I can't say back to normal, but they went back up.
Stuart, I think another thing you asked about what we've seen, Rick and I, the past year with some of our clients, and I'm sure you've seen it too when it comes to labor, is the other side of this argument. I'm sure there's people listening right now that think, well, it's so hard to find people today and find skilled labor that there's just not a pool of resources out there. So we're hanging on to people because they're talented. And yeah, our volume's not where it should be. So our numbers are going to be at 60, 65%, whatever. And it's not going to allow us to make adequate profits. But I tell people, if you're making a conscious decision to hang on to people, even though your volume's not there yet, you almost got to maybe break that cost out separately and realize that you're kind of investing in that in the hope that you get back to your prior levels. But I think that's another dilemma the industry's facing.
Yeah, I agree. It's, we've, you know, even in the past, before the pandemic, we had issues where, you know, a customer, let's say a major customer's lost, and you don't want to get rid of the skilled labor just to make the Stuart Margolis 55%. You got to, the stipulation that the CFO says, but there certainly can be a sacrifice, but it should be measured, as you said. The objective is to say to yourself, how much will we suffer if we have to go back to looking for a new employee? How much is that cost going to be? It's very hard to put a number to that, as you well know, because you could go through 3 or 4 freshmen before you get to the 5th one that's a great fit for your company. But sometimes what happens on the 2nd one or the 1st one. But one should make an estimate of that cost and make sure it makes sense that your sacrifice is worth it.
Stuart, just wanted a reminder, we're coming up on 12:30, so we'll probably get back to your presentation.
Yeah.
Keep chatting in the questions though, if anybody has any.
There's probably the screen that the ratio that I really like the most is the number is on slide 17. It's value added per factory employee. These are dollars and they're not ratios, and they go up each year. And this number is 2017, I believe. What I find is that there's a correlation with these numbers with the cost of living increases, and also with the increased efficiencies of the equipment itself in the industry. So that component of it is hard to measure. But at the same time, it's not, it may not be impossible, because again, in your specific company, if you haven't increased your technology that, or changed your technology, then one shouldn't expect the value added per employee to go up suddenly, unless you're managing your employees better. So I use that number. I actually have had that number, the total payroll number, on monthly benchmarking type of reporting, where we reported somewhere where the management can see it, and hopefully employees can see it as well, so that everybody has a goal to achieve, and the company is motivated to get things done. So this dollar amount is a little bit, if you show an employee, a pressman or the bindery employee a ratio, they're going to roll their eyes. But if you can measure the value added per factory employee and present it to them, some of our goal is to achieve 150 or 160 or whatever the number may be today. It's certainly something that they can understand. It's very useful. And again, if you go back to your management books, sometimes the best way to manage it is to focus on items that everybody in the company can understand. And this is one of them, for sure. So I think that's probably the one of my more beloved ratios, which is really not a ratio, but it's a dollar value amount. I have like I'm going to do 30 seconds left, right? So in the slides that you'll be able to get afterwards, there's a sort of a what do you want to call this, a calculation that we do that shows that value added and payroll itself are highly correlated. And one of our partners, or that I work with, New Direction Partners, Paul Riley, put this together a while back, but it just shows that the correlation is pretty strong. And so you'll be able to see that as well. It's just a proof to management that, you know, paying attention to labor costs is important because it's highly predictive of your profitability. The other things that I like to look at is EBITDA and which is earnings before interest, taxes, depreciation, and amortization. The one reason that I like to look at it is because it's a beginning of calculating what the value of your company is. One of the books that I really liked was a book that dealt with, I forget the name of it, but it's something like buy to sell, I think it might be called, if I remember correctly, where every company should be considering selling, even if you're not considering it, only because you want to try and maximize the value of your company. And so it gets you a little bit more motivated. One of the things that you need to do that is your EBITDA calculation. It's my father used to call it a poor man's approach to measuring cash flows. The simple calculation helps you calculate essentially your cash flows. And that EBITDA calculation can be rolled into a debt service coverage ratio, which obviously if you're a company, you're probably borrowing money. And so if you're borrowing money, you're probably, the bank may have a debt service cover ratio. But if you don't have it, you should be paying attention to it because your next bank may require it. So consider that as one of them. But the ratio study does not have EBITDA because we only measure factory depreciation, but it is we do have that available, and debt service coverage can't be calculated in the ratio studies itself, but you can monitor it on your own. You're really just looking for numbers above 1.2. Make sure that you're covering your debt service. So I have 3 minutes over. So Rick, you can discipline me afterwards, not now, later.
Well, yeah, thanks. And I think there'll be some more questions as we go through conversation here. So we'll just have to get your inputs on that. I know one question came in regarding contribution margin as a KPI. How common do you see that? Speaking for ourselves, that has become a very key metric, and it ties in to what Stuart was talking about before. Utilization of labor costs, for example, material costs, but also pricing. And so that's a great measure, I think, anyway, that can point you to issues in any of those areas. I just think, you know, I'm familiar with the ratio studies, the past ones, and familiar with so much of the benchmarking and performance metrics that our clients use. And there are as many clients as we have different ways of looking at things. And so I wanted to maybe give everybody on the call an opportunity to share what they may be doing or ask questions about some of the things that Stuart's talked about. I know we had one of our members from PIM here that couldn't join, but he wanted to make sure that he mentioned the importance of internal benchmarking, which I know you mentioned, Stuart, with budgeting and goal setting. They measure things like value-added sales dollars weekly and monthly, and labor metrics and sales measures. And they compare them, because the PIA ratio studies haven't been available, they compare them to their targets, to their budgets, to what they think industry goals should be. So they're looking hard at this stuff on an internal basis, and they do it on a weekly basis. And that particular member also pointed out that during COVID, in particular, cash flow has been king. And so they've really focused on this 13-week outlook, a rolling, we mentioned that in different webinars during some of our PPP webinars, but it's a rolling look at your cash flow your cash coming in, your cash going out. so this client said that's become a key focus of their management team. But I'm interested in seeing what some of the other things that maybe you guys on the call would want to talk about. I handpicked a couple of you just to get the conversation going. And so maybe if I could call on you right now, that'd be great. As a reminder, you have to unmute yourself. And I think if you're using a phone, what was it, *6, you'd have to use to unmute yourself. But maybe I could go to Ken Ryan first. Ken, you mentioned that you do some benchmarking and some metric review on an ongoing basis. Could you share some of that with us?
Sure, Rick. So Stuart, I've seen you talk in the past, and I love using the ratios. We use them every month, and that's how we grade out what we're doing internally. I had sent a chat message asking about, the COVID year, we'll call it. And our ratios and our percentages are so far off. What should we take from that going forward? So if I'm going to compare this year to last year, it's not even close.
I'd have to, it's interesting. It's really quite difficult to look at last year and even, you want to improve upon the year before, but honestly, you can't just accept those results as a baseline for improvement in some respect, assuming there were so many times during the year last year that we just didn't have a barometer as to what really was going to happen in the next 3 months. And so it was extremely difficult to put a plan together. And my suggestion is that you look at last year and realize, like, this is what happened. What kind of recovery do we expect in total sales dollars? And then, and I sometimes think you need to do it, especially in this kind of case, in more of 3-month increments instead of a full year budget, so that you can reevaluate at the end of at the end of 3 months, because the perspective is probably going to be better.
Sure.
Ken, this is Mel. I just wanted to add a couple comments to that, because we've had this come up quite a few times from companies asking that same question. How do we even evaluate last year? How did this impact the value of the company and so forth? So what we've tried to do is we look at last year, and then what we call the COVID adjustment column. And we try to look at it in terms of, and analyze all these differences in terms of, we say, was it a permanent difference or a temporary difference? What happened last year, is that going to impact us forever going forward? And when I say permanent or temporary, it's like, well, we hope a lot of our customers and sales come back to what we think are normal levels. But if we've lost a customer, or if that customer went out of business, that becomes more of a permanent difference. And then we kind of go through all the cost and expense areas and ask the same question, because last year was so different, right? And we just try to look at it that way, and then evaluate what happened last year based on permanent or temporary. I don't know if that helps or makes any sense, but that's what we've been trying to do.
That makes a ton of sense, Mel. And I guess the biggest skew for us was the labor. And it seems like we were able to control our spending in, like, say, entertainment, because nobody could go out. But it's the labor costs, and now trying to right size that, because earlier it was referred to, you don't want to get rid of someone just to save, make Stuart's number look good, and then be hamstrung because you don't have the skill set to get the projects done that you bring in now.
Right.
Anything else you're looking at there on an ongoing basis, Ken?
For us, we finished our fiscal year in March, so one thing we're looking at is the value of the company, and we're working with our accountants and our evaluators to figure out basically the COVID effect with all the PPP monies, and so that's been our biggest process right now that we're getting through.
Can I say something here? I've spoken to several private equity firms recently regarding the sale of a couple of companies, and I've done things to adjust EBITDA that I've never done in my entire life because of this COVID. So I took I'll take a 3-year period of EBITDA calculations, and if I have 2000 and what would it be 19 and 18 are making have been relatively close to each other, and of course this last year is low. I add back enough of the PPP loan to make it get back to the same levels. And it's sort of like what Mel said. I've said, look, this is what happened. Our sales dropped, but we received the government grant to supplement for that, and that's what I'm showing. It's a government grant, and it fills it in. I'm not asking you to consider that our company's EBITDA is even higher than the prior 2 years, but it's not lower than the previous 2 years. Once things go back to normal, we will get the 1.5 million or 1 point whatever it is. We'll get back to that. So if you're not forced to sell, but if you're still, considering a sale, and surprisingly today, the money is still out there. And the multiples, though I wouldn't call them high, they're there. So you just have to convince those buyers that you're not going to sell it for an EBITDA number below what it was at least the prior 2 years.
Sure. No, Stuart, we're employee owned, so that's why we were looking for the valuation.
Yeah.
So, but it's the same thing as we're trying to explain to our evaluators that that factor in that PPP, because we tried to hit our numbers best we could.
The CPAs out there have all been read in by the AICPA, and it said that it's debt forgiveness, but I've taken the approach that it's a grant, and it's an argument. That's all you can do.
Yep, correct. Thank you.
Thanks, Ken. Stephanie, we talked a little bit last week, and I know that your company does quite a bit in benchmarking and metrics without disclosing confidences or anything. Would you be willing to share some of that?
Absolutely. We are probably more like what you had somebody call in, where we do a little more on the internal side. I have never been exposed to the ratios, but I am brand new in my position here. So I do know that my president is familiar with them. He's talked about different peer studies. He kind of goes about his own peer studies, though. We are fortunate enough that we've got several peer shops that he is in close contact with. And so our analysis really is based on the income statement. So we're looking at our sales, we're looking at our COGS percent. We are definitely looking at our production payroll. We recently acquired wide format into our shop right before COVID. And so we've been measuring wide format sales and how that's affecting us. But we really benchmark with the companies that we have contact with. They share their financial statements with us, we share with them, and we kind of measure where are we compared to them. He also has a tendency to send out pricing studies he'll send them out to probably 8 different shop owners and maybe get 5 back. And just like you guys were talking, what we're looking for there is, where are we on a coil bound book? Are we pricing it average? Are we pricing it high? Are we pricing it too low? And then we adjust according to those studies. That's kind of how we do it.
Good.
Real simple.
Good. Thanks.
So Mel, or Stuart, I'm Bob Anderson, and this is my first time joining this group. I'm out of Arizona, actually. So what we do is we run off your numbers, and I've run off your numbers for 21 years here. And we have them lined up in our financial statements, and we run off the best performing numbers. And so that's what we've always done. But what I find is, and as this company's changed and morphed here, that you add grand format, you add data, you add mailing services. So you're starting to sell a lot more stuff between, we do over 300 storefronts that we run. So that our digital department's got a very high VA. So our VA continues to move a lot larger number than what's in PIA right now. And I think that's some of the things I've had issues with the PIA numbers, where SGIA had no numbers. And you got to start looking at lots of different categories, because your company is not just a sheet bed shop or a web shop anymore, or a blended shop. It's just got a lot more services. And so that services is really changing the number. So we've looked at our number at VA is, we came up with a blended number right now. We want to be at 70, even as at 70%, sometimes 71% is where we want to be on our VA now, because of the blending of the company and where we're at. And I think those go ahead, Teresa.
So first I was going to say, I'm so happy that you were able to join us today. Thank you for logging on. But you mentioned best performing numbers, and that's what you're comparing to. And is that from within the best performance that your company from within have achieved?
No, yeah. So that's our goal. We take PIA's best performing top companies, and that's our number that we shoot for. And we've done that, like I said, for 21 years. So we've grown. When I took the company over in 2000, it was $1 million in sales. We're going to probably do about 52 million this year, just out of Arizona. So we run off that number, and we bar off of your number. And we use all the metrics in every category there. But again, what I see is that, technology, of course, is increasing VA, because technology is doing that. But I believe also the amount of services that you've shifted to is also increasing your VA as much, if not more, than technology in some cases. So I think that's some of the things when you're doing ratios now. I think you have to really look at what other services you're offering besides just that traditional model that was in PIA for so many years.
Bob, that's probably one of the most difficult things we have in front of us in the ratio studies itself, and for every printer that I have out there. I have clients that are in, let's say, ballot printing, who have more, labor costs and programming, and they want to know, what do we do with this labor cost? Well, to factor labor costs, as ridiculous as that sounds, and you just have to understand what people are there for, and what kind of value added you should expect for that particular group. So you're doing wide format, and you go to mailing, and then you go to bindery services. They all contribute different. They all contribute a different value added. Their cost per unit is all different, and so it's a big math problem that changes the next week. But that's why printing companies struggle to make money, because it's never, it's not consistent. It's not I got a contract, or I got 10 contracts, I'm going to produce them next month and I make money. It's never that simple.
Bob, when we had some planning meetings regarding whatever the next iteration of this ratio study might be, that topic got a lot of discussion, is trying to get more product category or segment information, because it's a challenge. So many companies do so many more things today than they did in the past. So
and I think I look at that when you're using you need to be able to. We're really working at pulling a P&L by each category now, and then trying to come up with that blended numbers off of that. You know, if we can, we try to find other areas where we can compare to, but I think you almost have to pull some type of P&L by each area of expertise you're in. And we want no area to be less than 10% of our business. So we really focus on how we're going to value that and how we look at that category versus others, so we can, you know, measure up against each area.
Good.
And Bob, one of the things that I've done in the past is I've taken the sort of the breakdown of these different product categories or services that are supplied, and I've allocated the material costs and the labor costs to them, and then just calculated. I can't call it value added, but we'll call it gross margin for just the for the sake of, or contribution margin, so that I can monitor all of the contributions to cover overhead costs. Now, obviously, the mistake there is that, you know, some departments are buying that $1 million piece of equipment, and others you've bought the operator a computer, you know, to do some programming, and so the investment's not particularly attached to that. But you could attach it. It's just that it becomes you know, typically the investment is a fixed cost that just amortized, and, you know, I struggle with what does that help management understand? I put a fixed cost in there that they can monitor every month, but you get the idea, I hope. But, you know, sometimes it's good to measure that gross contribution in not just the materials or value added sense, but also by minus the direct labor that goes into that.
Stuart, I think your ratios, I know you haven't, you know, like you mentioned, haven't done them for a few years, but going back, you know, I can remember 10, 12 years ago, you always attempted to break things out by size of company, region of the country, but also, you know, you'd have separate ratios for sheet fed printers versus web versus digital. You know, you attempted that, but I think what Bob's saying, in today's world, it's different again, and that's going to be a challenge. But like, you know, it is needed to try to break these segments down into large format or whatever. A little more.
I have to say that in the 60 years that my dad and I worked on this thing, that argument has never stopped. It's always there. It's not going to disappear, for sure.
Yeah.
Every pen company is going to be different than the average, and there's always going to be a new service or a new product that's going to skew what you would normally call an average. But that's, you know,
yeah,
that's part of it.
Carl, I see you're on the call.
I was just going to mention that. Go ahead, Rick.
I'm sorry, Carl, I see you're on the call, and you guys have recently done some things on metrics. Maybe we could share a little bit of that, and then maybe move to wrap it up with Steve and Teresa, Mel.
Yeah, sure. So like a lot of other people saying, we've kind of had the same issues of, we've used these PIM ratios in the past as kind of a comparison, a data point to compare ourselves to. And, you know, we know too, there's certain parts where we're better and certain parts where we're worse, just based on, you know, what the products that we do compared to the average printer. And we try to adjust and compensate. You know, we know we're higher here because of this and that. And we know we're better here because of this and that. And we've just kind of made those adjustments as we do our comparisons, but it's still nice to have a benchmark there to do some sort of comparison against. And within the last year or two, we've really focused, really trying to drill in on the labor efficiency piece of it, which you've kind of focused on too, and looking at, you know, without more recent PIM measurements, kind of just more against ourselves and how we've trended over time and how we've done through this pandemic. And like Mel was kind of referring to, how much of it is sustainable and how much of it is going to kind of regress back to the mean in the future here as the kind of market and economy corrects itself.
Have you seen gains in efficiencies during COVID?
Yes, we have. I mean, we've certainly seen better ratios from our labor efficiency standpoint, and labor to VA and labor to revenue has all improved. And we've certainly taken a hard look at our labor costs and tried to make ourselves as lean and efficient as possible during this time to help our bottom line as we get through until our volumes come back to where they were, pre-pandemic.
Good. Well, if anybody else has anything or questions, certainly let us know and chat those in and we'll get answers back to you afterwards. But Mel, do you want to kind of try to focus on wrapping it up?
So before we do, if you wouldn't mind, we've got a couple minutes left. I have two questions that I'd like to ask all the attendees before you go. The first one I think is probably pretty easy, but it's because if you're on this call, you're probably interested in this topic, but we want to make sure that we understand your interest in that you do want to participate in a new affiliate managed performance ratios program. So if you could just complete the poll here, we can kind of get a sense to make sure that this is a program of interest for you. So just click yes, no, or maybe, and we'll give you just a couple more seconds. And then I just have one more question. All right, I think that's probably going to be about what we're going to get. So I'll share the results. Not surprisingly, we had the vast majority of yes. We've got no no's and a few people that would need a little bit more information. Right? Completely understandable. The next poll is, hold on, stop sharing results, is there's questions about how we accumulate that data, because it's data that is obviously needing to be secure. It's obviously needing to be controlled. And so there's concerns sometimes about how this data might be shared. So as we move towards the development of this program, we're looking at different ways to capture the data. And we just want to know what your preference is, because we don't want to put any barriers in the way of how the program is launched. So it could be done via Excel spreadsheet supplied to a third-party data compiler, such as Stuart. Or it could be inputted online. In our current affiliates wage and benefits survey secure portal, where about 500 companies are already participating in uploading their wage data. Or it could be input online in a third-party data compiler secure portal. So that would be just a different portal that you'd be uploading your data to that would not be affiliate related. Or it might be a pen and paper, or perhaps a pencil if you need to make, if you make a mistake. So share, if you wouldn't mind, how you would like to share your data and what would be the most comfortable for you. All right. I think we've got, okay. I think that's everybody who participated in the first one has now completed the second. Is that everybody? All righty, so we're going to end that. I'm going to share the results. Interesting, we've got 7 who would like to supply by Excel spreadsheet. We've got 7 who would like to input online the current wage and benefit portal, and 2 who would prefer a third-party secure portal. And nobody's interested in bringing back paper and pen, so that's good. Okay, all right, well, thank you for that. We'll keep you informed as this program evolves, and we're looking forward to your partnership. Mel, anything that you'd like to share to wrap it up?
Not much, Steve. Just say thank you for joining us. We'll be in touch with future topics, and just a reminder, the June 10th one that's just around the corner on planning for profits and what you have. And Steve, I'll be in touch with you and Teresa about getting that out to the members as well.
Yeah, I just forwarded that to Teresa, so they have the information, and I'll make sure that you get copied on that, Mel.
Great. Thank you, everyone.
Excellent.
Everybody.
I'd also just mention that July 28th at 11:30 is the continued session of this program as well. So if you pencil it in on your calendar, you'll have it secure, and we'll move forward from there. Thank you to all who attended today.
Thanks, everybody.
Thanks,
Thank you.
everyone.
Thank you.
Really appreciate Stuart and Rick and your leadership of today's event. Thank you again.
Thank
Thanks for the
you.
invite.
Thanks. Bye-bye.
Bye-bye.